You know the routine. Checking your crypto wallet a dozen times a day, sweating over every market dip, and trying to time a breakout on a coin you saw on social media. It is an exhausting way to manage your future. But look at the data. While the active trader is burning out for a success rate under 25%, the passive investor is quietly compounding. When we look at 20-year timelines, simple index strategies have historically outperformed 94% of the professionals. The financial industry rarely highlights these numbers. They make their money selling the idea that investing must be complex and exciting, because complexity allows them to charge higher management fees. This creates an ignorance tax. It is the real cost of missing the mathematical realities of simple investing, money that leaks out of your portfolio through fees, taxes, and missed opportunities. We are going to break down 10 unsexy, boring money moves. Each one is designed to provide a specific mathematical advantage that makes them more reliable for building wealth than chasing the next volatile trend. We'll map these moves into a sequential master blueprint. This is an order of operations that shows exactly where your next dollar should go based on where it can earn the highest yield. Trading the dopamine of the daily market for these systems is how you reclaim both your time and your eventual financial independence. The first move focuses on capturing the only guaranteed 100% return in finance, your employer 401k match. If your employer matches 50 cents on the dollar and you contribute $3,000, you get an immediate $1,500 match. That is a 50% return before a single dollar is even invested in the market. There is no crypto coin or stock pick that can promise an immediate return like that. Every month you ignore this, you are effectively leaving free cash on the table. Once that match is captured, the next priority is erasing the ultimate wealth destroyer, high-interest credit card debt. The average credit card interest rate is now over 22%. Trying to build an investment portfolio while carrying a balance like that is like trying to run a marathon while dragging a boulder. The interest costs will likely wipe out any gains you make elsewhere. Paying off that debt is mathematically the same as earning a guaranteed 22% return. In the current market, that is a risk-free yield you can't get anywhere else. Step 3 is about building a defensive buffer. Before you put your cash into the volatility of the stock market, you need a safe place for your emergency savings. Most traditional banks pay around 0.39%. High-yield online accounts currently pay 10 to 12 times that. You are earning significantly more money for the exact same act of having a savings account. This buffer changes your relationship with risk. Having 3 to 6 months of expenses liquid means that when life throws you a curveball, you aren't forced to sell your long-term investments at the worst possible time. For cash you don't need immediate access to but want to keep safe, step 4 is parking it in short-term treasury bills. T-bills are backed by the full faith of the government, making them nearly risk-free. Crucially, the interest is exempt from state and local taxes, which provides a higher real yield if you live in a high-tax state like New York or California. These moves aren't about striking it rich. They are about building a mathematical fortress around your portfolio so your long-term wealth can grow undisturbed.
Now we enter the core growth phase. Step 5 is aggressively buying broad market index funds and accepting that average performance is actually the goal. As we saw earlier, simple passive index funds historically beat 94% of the professionals over 2 decades. They charge almost nothing in fees, meaning more of the market's growth stays in your pocket. Move number 6 is utilizing the Health Savings Account, or HSA. Most people view this as a way to pay for doctor visits, but it is actually a specialized wealth-building tool. This is the only account with a triple tax advantage. You get a deduction on your contributions, the money grows tax-free while invested, and your withdrawals for medical expenses are completely tax-free. Move 7 is shielding your long-term growth within a Roth IRA. With a Roth, you pay taxes upfront on the small amount you contribute today. In exchange, every dollar of growth that happens over the next 30 years is shielded from the IRS. Your entire harvest in retirement is tax-free. Instead of hoping for a stock breakout, Move 8 is about building a dividend compounding machine. When you reinvest those dividends, they automatically buy more shares, which then generate more dividends.
It creates a snowball effect that grows your holdings without you having to add an extra cent. These strategies work because they require non-action. You aren't trying to outsmart the market. You are letting time and tax-advantaged structures do the heavy lifting. Even the best portfolio can be derailed by lifestyle leaks. The largest of these is the habit of tying up massive amounts of capital in depreciating assets, specifically new car loans. The average car payment has reached $767 a month. Over nearly 70 months, that is a staggering amount of capital that could be working for you instead of paying for a vehicle that is losing value. If you bought a reliable used car and invested that same monthly payment into the S&P 500, that single decision could grow to approximately $1.58 million over 30 years. To make all of this work, you need the final step: absolute automation. Relying on willpower is a losing strategy. The most successful investors set up their systems so the money is moved to their investment accounts before they even see it in their checking account. Automation removes the daily decision-making process. It bypasses your own brain's tendency to spend, making your wealth building inevitable. Building wealth doesn't need to be exciting or stressful. In fact, the math shows that the more boring your strategy is, the more likely you are to actually reach your goals. Here is your next move, depending on where you are right now. If you are the burnout trader, stop trying to beat a market with individual picks. Transition to index funds and reclaim your mental energy. If you are the anxious beginner, ignore the noise of the market. Your priorities are the 401k match, paying off credit card debt, and building that high-yield buffer. And if you are the system optimizer, focus on tax efficiency. Max out your HSA and move your extra cash into T-bills to protect your yield from state taxes. Don't try to do all 10 today. Pick the one that addresses your biggest current financial leak, automate it, and step away. Wealth isn't about hitting the jackpot. It's about setting up these unsexy systems and letting time do the work while you go live your life.